CME Group launched Micro E-mini Futures Contracts. Discover how a smaller Micro E-mini Futures Contract opens the world to greater trading possibilities.
Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Good to see you, Jeff.
Well, I'm fired up today. We're seeing a lot of market pressures, ebbs and flows coming in, demanding that the Fed change course. So my question to you today is, will markets be disappointed if the language is not going to coincide with potential rate cuts by the Fed for 2019?
I think you got it right. How could you not be fired up with this going on? Absolutely, the market will be disappointed. The Fed needs to word things right today.
Well, it's interesting to see 11 of the last 12 Fed meetings, that Q&A that comes out of the Federal Reserve has disappointed markets to some extent. So maybe today's going to be more of the same, or we do see the anomaly and we see markets move to those all-time highs.
Yeah, markets will be really disappointed if we get pivot number 2, which would be something more hawkish than they expect.
Getting dizzy with all the pivots. But let's move into the first lightning round, Bob.
Ready for it.
Crude oil rebounds. Geopolitical tension, troops being moved over. There's a lot of moving parts in the crude oil patch. Talk to me on WTI.
Yeah, we're also looking at a slightly more optimistic trade picture. So I'm looking for upside here. The example I want to talk about is buying the week 4 June 57.60 call spread in crude oil. I'm buying the June week 4 57 call for $410, and I'm selling the June week 4 60 call for $90. Buying in this call spread costs an investor about $320.
That makes a lot of sense. We're seeing the expiration on this call spread example Friday, June 28th, and we're seeing the August futures being the underlying future contract, which we're trading around 54.29. Lastly, with the at-the-money volatility was 41.50. But this really coincides, Bob, with the previous range we had. That's how we're going to gravitate potentially up to $60.
And that is elevated volatility, but if we get geopolitical problems, it goes up to 60, 65 in that vol register.
I like that, Bob. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round, pal.
Let's do it.
Fed. Well, we talked about this imminent rate cut, or at least the language state to set up that July rate cut, correct?
Yeah, there's a high probability that we get a cut this year, so that should be what they're setting up.
And as the markets are knocking on all-time highs, the trade example I want to utilize is buying a call spread. Looking at the E-mini S&P 500, week 4, 29.50, 3,000 call. Yes, Bob, I actually said 3,000. That would be a new all-time high. But it makes a lot of sense here. The investor is going to spend $583 for this call spread. But in the event we do see some optimism, and don't forget about potential trade tariff resolution coming down the pipe in the same month of June, we could see some optimism and move higher dramatically.
Yeah, you could see the perfect storm, which would, in my opinion, take us to new highs. So this may seem pricey to some, but taking advantage of that upside with that long time to expiration, I like this example a lot.
And the expiration on this was Friday, June 28th. As you remember, very important to understand that the September futures were the underlying futures contract, trading around 29.23 with the at-the-money volatility only at 14.93. So there is some more room to run on that volatility component, Bob.
Yeah, the volatility is slightly high, but it's certainly not elevated.
All right, Bob, I want to thank you, as always, for coming on Striking Options. And please tune in every week as we will continue to strike options.